Right, now we're going to do exercise 4.14. When you read exercise 4.14, the first thing that you determine is that this business has been working on an annual accounting period that starts from the 1st of March to the 28th of February 25. Now, we bought vehicles a long time ago. We bought it like 3-4 years ago, and that was the opening balance for vehicles. And then up to this day, which is the beginning of this year, this is the amount of depreciation that's been written off over the 4 years or 3 years time. Then they carry on by telling you that when you work out depreciation, it would be 20% per year on the diminishing balance, which is the book value. How do we get book value? Cost price minus accumulated depreciation times 20%. But now what they carry on is, they say that on this date, the 1st of March, so the first thing you need to realize is that on the beginning of the year, they are selling that van. It's only one van. So this vehicle here is one van. All this vehicle has as a depreciation, accumulated depreciation of 61. They're going to sell that whole amount of vehicles. So it's only that vehicles consist only of one van. So we're selling that. So now we're selling it for cash. So the transaction is a cash sale to P. Mara for 74,000. We're selling it for cash. So if we were to do it then in a journal, we will do the cash transaction in the cash receipt journal. All right. So now we can't do the transaction yet because that's step 3. So we're going to start with our steps. Step 1, remove the cost price of the vehicle and put it in asset disposal, your work account, so it goes there. Can you see that? Step 2, remove the accumulated depreciation of that vehicle, which in this case is the whole of it, to the credit side of asset disposal. Step 2. Now there's nothing in vehicles, there's nothing in accumulate. Why? Because there was only one vehicle. So these two accounts are now closed off. Normally you would balance them, but because this is only one vehicle, we are now closing them off. And now our vehicle is in the display room, in the work account. There's the cost, there's the depreciation. So this vehicle is, the value of this vehicle is 64,000 Rand. It's worth 64,000 Rand. Okay. Now we do step 3. Step 3 is transaction. It can be cash, then we write bank. It can be credit, then we write debtors control. It can be trade in, then we write creditors control. Or if it's a donation, we write donation. Or if it's the owner taking it, it's drawings. Any of those 5 things we can write here at that point. But it's cash. So the cash amount is 74,000 Rand. And now we need to determine, did we make a profit or did we make a loss? So if that side is 135 and that's 125, or if that's one way to look at it, the missing amount is on this side. So obviously if I've got it here and I go to the credit would be, profit is an income account. So on the credit side we will have incomes, increase owner's equity on the credit side. So that's why we credit the profit. So we take the profit, the missing amount, and we put it here. You easily also could have done it by saying 125 minus 61 is 64. We're selling it for 74. We're making a profit of 10,000 Rand. So in your head, you can also do that sum. You can do the calculation, but in the account, you can also do the calculation. There you've done your 4 steps and you are finished with that account, and the whole purpose of this sale was to determine profit or loss. That's the star account here, which will be used in the income statement. At the end of the year, we're going to close it off here to profit and loss account. I'm just saying that to you so long. Right. To record the actual transaction, we will put it in our CRJ. Say we received money from this person. What for? For an asset that was sold. Okay. These same steps that you do in your general ledger, you also can be asked to show it in the general journal. So, when you have to do your general journal, you go step into the journals. So step 1, take the cost price is step 1 of the vehicle. So you take it out of vehicle, so vehicles credit, asset disposal, debit. There it is. Step 2, transfer the accumulated depreciation. Step 2, accumulate is always credit. How do I take out? Go to the opposite side. So I debit accumulated depreciation and I credit asset disposal. Step 3, transaction. It's a cash transaction. That's why I've done it in my CRJ. That was step 3. Step 4. Calculate the difference between the two to see if I've made a profit or a loss. So how did if you have to work this out, you say, okay, what's the difference here? 125,000 minus 61,000 is the book value. So that is 64,000. My selling price 74,000. So I had a profit of 10,000. Okay, selling it with a profit of 10. What do I do? Profit is an income. So I go income credit, asset disposal, debit. Why? Because this is an income account. That's why I credit it. All right. So there's your 4 steps again. Sorry, that's step 4. Okay. Because it's a cash transaction, we showed the transaction in the CRJ. If it was a creditor, a debtor, so you debit, you think it's sales, but you can't use sales because sales is just for stock. Therefore, your step 3 will also go here. It would be debtors control debit, sales credit. If it was this person that you're selling it was Mara, it would have been P Mara debit. Debtors control that for that column there for debtors control. You will also use the debit there. But it's not a credit sale. If it was a trade-in, it would have been P Mara, or it would have been, let's say, Toyota, debit, asset disposal, credit. Because your transaction will always be, the transaction part will always be on the credit side of asset disposal. So asset disposal, credit. So what debit? Trade-in would be creditors control, the name of the guy. And then you would just use the creditors control column here on the debit side. Because remember, it's a trade-in. So we're giving it in and we're going to owe them less. And that's why we put debit there. If it was a donation, it would have been donation debit, asset disposal credit. If it was drawings, it would have been drawings debit, asset disposal credit. Right, and this is an asset disposal account. An asset register. Can you see? We spoke about an asset register. That's year 1, that's year 2, that's year 3. And now we show up to the beginning of this year what was the value of this vehicle, 64. That's why we knew if we can sell it for 74, we're making a profit. Okay.